Hello, my name is Dr. George Mochocki, and welcome to Fin225, International Finance Management, offered by Harper College. You're either taking me in an online class or a face-to-face class, and this is part of your discussion as a summarization of your lectures that we've had in class, or from the discussion board if you are in an online class. Make sure you print out the concept maps, and you have it's usually 2 pages in a PDF file. So when you're doing the reading, add into the notes that you think is important, and then discuss them in the classroom. And then afterwards, look at this YouTube video and go and say, "Hey, I understand this." All right, so let's go into our lectures. Remember, I'm trying to keep them underneath an hour. So we're going to be looking at this from a parent's perspective. How do I manage and control my managers or my subsidiaries to add value to the corporation, to the parent MMC? Okay, so international corporate governance. Let's see how we have this one in here. Let me just close this up here. Just general information. Remember, you already read the chapters. We discussed this, and this is a supplement. This is just a refresher afterwards. So unless you read it, if you think you just get everything out of here, you're going to be mistaken. You won't know it. This isn't the first exposure. This should be after, like I said, you read it, you looked at it, we discussed it, and now you're saying, "Oh, now I understand. Now it makes sense," as a reminder, so to prepare you for your exams or for the paper that you'll be doing as a team. Remember, you'll be creating a multinational corporation, a new subsidiary, and some of this information, even from this chapter, how you're going to manage and govern the managers of that subsidiary. Okay, so let's go back, and this is kind of a refresher from introduction to business that you have, or business organizations that we had, and it's a board of directors, right? What are the board of directors? The hierarchies, they're appointing the high-level managers of a firm, just a refresher, including the CEO. Make sure that the key management decisions are in the best interest of the shareholders. So remember, the shareholders elect the board of directors, and the board of directors elect the management. That's how I'm not part of managing the company, so that gives me just as an investor. So when they, and to limit my liability, and that's all from Business Law 1 and from Understand Business Corporations. Okay, boards are not always effective at governance. They're not the best. Remember, they're more perceived, or there's a contact with somebody else, another board, to have some kind of a relationship. There's more a hidden agenda sometimes with some of these board members. Some allow the firm's CEO to serve as the chair of the board. So now he's part of the board member. Remember, the board member is supposed to be a separate entity to make sure how they're hiring the management. But that's part of the rules. You have to understand. Boards typically contain insiders, managers working for the firm. The problem with that, when you got managers working for this firm that are on the board, might prefer policies to favor management and not necessarily the shareholders. Board members who are employees of a foreign subsidiary may maximize the benefits of the subsidiary. So if a board member on the parent organization and he is or she has some relationships or contacts or some vested interest in the subsidiary, they may skew it towards, remember you had the political, those who've taken me from management classes, the managers have their own political agenda. They're not supposed to, but remember the whole thing going forward, that the management is to add value to the parent MMC. Okay? Okay, governance by institutional investors. Now, if you look at institutional investors, because who are institutional investors? They're pension funds, they're mutual funds, index funds, hedge funds, insurance companies. They buy a lot of the shares. They buy a lot from different companies. So they have that input. They have that, you have a lot of small investors, but you have the large ones, which they buy by block, for lack of a better word. We'll talk a little bit later, but they're institutional investors. Commonly hold a large portion of the firm's share and ability or willingness to enforce governance. They basically varies amongst the types of institutional investors. If you're looking later on, we're going to talk at someone that's an activist and he or she owns a lot of the shares. They may want to change the management. They may want to change how the organization is running. They may want to get more return on investment over the institutional investors. They're looking more for a steady flow of cash coming in. They like the ups and downs, but remember, hedge funds and insurance companies, I like to have that income I build relationships, but I like to have a steady flow of income that is consistent over a long period of time. If I have consistent income, I could plan properly as I expand the MMCs into other, geographic areas or markets. Okay? So now, international corporate control. Okay, let me just close these off here for you. Okay? Let's go on this one. For market for corporate control. Okay, so what's going to happen if managers make decisions that destroy the value of the MMC? Could be subject to takeover. Managers could lose their jobs. Market for corporate control, and this is looking at the leverage buyouts. So if I'm looking at management has to be able to relate well to the shareholders, because the shareholders are the ones who control the board of directors. They don't like the board of directors. They don't like what the manager's doing. They get rid of the board of directors and they bring in new management control. But remember, sometimes because of the decisions that the management could do, the parent MMC could do, or the subsidiary could do, they could basically destroy or reduce the value of the parent MMC. Okay, motives for international acquisitions, comparative advantage. Remember, two are better than one. Better form for direct investment. Okay, so I'm getting in there, and we've talked about that in other chapters, but in a quick nutshell, if I have any kind of acquisitions, everything else, there's a benefit to add value to the parent MCA. It could be a distribution plan, it could be a logistic, it could be a transportation, it could be a manufacturing, it could just be a market that I want to get into. Okay, trends in international acquisitions. MMCs are in various countries. Remember, they're looking where it makes sense for their market or their product, for either to minimize their exporting and to maximize their importing potential. Tend to focus on specific geographic regions and use stocks or cash to make their purchases, depending on shareholders' power. Generally increase over time, however, the plays showed during the credit crisis. When I look at shareholders' power, it's more the institutional ones. Who owns the majority of the share that I have to satisfy? What are they looking for? They're looking for stability, they're looking for growth. Mostly they're looking for growth. Okay? International acquisitions. Looking good? Okay, the next one, I just look at what I have a view. View here. I got it, 200. Okay. Barriers to international corporate control. Anti-take-over amendments implemented by the target. Someone doesn't want me to take it over. I want to have acquisition, so the target may implement anti-takeover amendment that requires a large portion of shareholders to approve the takeover. It's not like a poison pill, but the policy. I have to get a majority. Then you have to look at it. Some companies, depending on the stockholder, who are my investors? Who are my shareholders? If they're institutional, it's a little different. I kind of have an idea which way they're looking for. If they are individual activists that own a lot of shares, that could be a game changer, and it could let's look at it, leave it as a game changer. Okay, now, poison pill implements by the target. That's the host country, that's the company that doesn't want to be taken over. Grant special rights to managers or shareholders under specific conditions. So, you have to pay them out, you have to do this. So they're basically protecting them. It's like a poison pill. Remember, when I'm taking over a company, I have to take all the contractual agreements, everything that's in there. And it's going to cost me so much, either buy them out, or what's the ultimate cost of buying that piece of property, or that investment, or that venture, and how much it's going to cost to turn it around. Okay, host government barriers. Governments for some countries restrict foreign firms from taking control of local firms. Regulations, some factors. They may allow foreign ownerships of local firms only with specific guidelines, that maybe I can only take 49%, but 51% has to be by a local. Okay, model for valuing a foreign target. Okay, we've got a lot here. Let me just go in here. Okay. And I have these in here. Remember, you have everything else. If you miss it, they're all in the book. Sorry. It's all active. Okay, so in an MMC, so what are we going to be looking at? Let me just shorten this up here so we can see everything. So in an model for valuing the foreign target, what's the model? How am I going to value it? How do I put a value on it before I purchase it, or what is the value now, so I know is it adding value to the parent? Anytime I'm bringing something in to my operation, it should be adding value. When an MMC engages in restructuring, it affects the structure of its assets, which will ultimately affect the present value of his cash flow. Here's the formula. Here's the net present value. Initial outlay needed to acquire your target, cash flow generated by the target, acquire rate of return on the acquisition, salvage value of the target, okay, and time when the target will be sold by the acquirer. Okay, basic formula. Add it on. You can stop and look at it, and then as we start building on, we have an example. You could utilize this formula in there. Okay, estimating the initial outlay. Again, firms commonly pay premiums above the prevailing stock prices, because I want them to buy the stocks or keep them happy as an investment, a foreign target to gain ownership. So I'm buying them ahead. It's never been moved. I'm going to buy out. Now I have the majority. If the management doesn't want it, I go to the board of directors, change them, and they bring another management. Everyone wants their job. Initial dollar outlay. That's what the IOU, initial outlay of dollars, determined by the acquisition price of the foreign company. Okay, outlays, initial outlay by the foreign company, and at the spot rate of the currency. And here's the formula. Add it in. USA is equal spot rate. That's what's going to do, is the determined initial dollar outlay. So I know what it is, but the spot rate is my exchange rate. What is it this time? What's going to cost? Gives me a general. I know it could change, depends when I'm doing it. I'm looking at it now. Looking at my initial outlay. Okay, estimating cash flow. Estimated foreign currency cash flows, that's money coming in, that are to be converted, must account for any taxes, block fund restrictions by the government imposed by host government. Dollar amount of cash flows to the U.S. firms is determined by the foreign currency cash flow, CF. Let me do this. Cash flow, foreign investment, right? In a period. Spell that wrong. And the spot rate at the same time. Okay, there's your formula, and you'll need them in a little bit. The net present value at the dictionary. Net present value of a foreign target can be derived by substituting the equalities just described in the capital budget equation. Okay, capital budget equation. Okay, so there's my capital budget equation, net present value. Look at it. It walks you through it. You have all the variables here, and it will be looking at it. Remember, print it out. When you look at it in the book, each one of these, there's an example. The author does an excellent job. Gives you a simple example. The only complaint I have is real small, fine print. Blow it up. If you had the ebook, you're happy. Just make it larger. Okay? Okay, so now you have that. Now, the impact of the SOX, the Sarbanes-Oxley Act. Those of you who had accounting, intro to business, corporations, or finance, this is it. These are all the rules of procedure. We're going to sign off. Everyone has to do it. It's very affecting the small and medium businesses because it's a cost effect on that. You know what I mean? Because it's so much paperwork, more of the red tape that I have to work with. Okay, a quick refresher. All right, and like if you really want, I got the site here real quickly. Let me just. I'll get it later. Okay, the reason for the act was we had the Enron. You had all the high level misappropriation of funds. Being very careful here. Okay, improve the process for reporting profits used by firms including U.S.-based MNCs. Requires firms to document an orderly and transparent process for reporting so that they can not distort their earnings. Remember, there's always numbers. Numbers don't lie. Liars lie. I can adjust the numbers so it looks like it, or I put it in holding, or I didn't bring it into this quarter. So this quarter, my looks like I'm profit because I didn't show a certain expense. I delay. There's a lot of different things. I'm not trying to look at the negative side, but this is what it came up. And it was done on such a larger scale for a large corporation that had a lot of the effect of the financial meltdown other than the housing and everything else in there. So that said, what happened is now the rules are so stringent, it goes all the way down to the mom and pop. It's just very cost effective. It's a lot of red tape. Doing more red tape paperwork, and they're not going to have that much of an effect on the total economy of a government. So they're looking at some changes, go from one extreme to the other. But it's right in there now. Requires more accountability, oversight by executives and board of directors, so they can be held accountable before if the company did something wrong. It's just the company paid a fine, and the executives, they got their bonuses, walked right now, they could do time. Okay? And this site here basically is this, you got the compliance, the sections, introduction, those who are looking at it, different sections, to a major change to regulation, financial corporate governance, that's why it ties in here, named after Senator Act as arranged, 11 titles, and you have the 11 titles, miscellaneous. So it has the information if you want for more, just to be aware of it, okay? And I know you already covered that in accounting, and you've covered in the corporate finance, and I was just carrying over as we were doing international, all right? So that took care of that. Now, factors affecting target valuation. Target specific factors. Target, I'm looking at the target where I'm going to go to look at the valuation, looks at previous cash flows, managerial talent of that target, a subsidiary that I maybe want to go into. Okay, country specific factors. Target's economic condition. Now look, this is no different internationally, if I'm looking at geographic, than what I would do domestically. If I'm here in Illinois, I know what the economic conditions are. I want to go to California. What's the economic conditions there? What's going on with all the fires? Is it going to hazard? Is it delaying the logistic? If I got a distribution thing, so I'm looking at all that. So now I'm just looking at it globally. So globally, I'm looking internationally. Where's my subsidiary? What are the factors? What's the political condition? And we've discussed that more in detail in previous chapters. What's the industry's condition? What's the whole industry in that area? If I'm going to be buying, remember we talked about the other one that they're doing, the tennis rackets in Singapore. What's the currency conditions? What's the local stock market condition? I'm going to China. I'm taking the gamble, but I got to understand it. But do I invest real heavily or just slow back a little bit? Are taxes applicable to the target? Okay, so those are factors affecting the total evaluation because that's part of my yield. May look good, but then also, oh my God, what's going on here? So I have to take all the factors to see what's the net. Is it going to add value to the parent organization? First of all, is there value in that subsidiary? If not, I may get a good deal. Maybe what I'm looking for market share. So I may get, anything else I'm buying. It's not worth anything. But then I know for my overall strategic, after 2 or 3 years, I can make it a valuable aspect because I'm going into my strategy this way. Okay? Okay, example of valuation. Now this one I'm just going to go real quickly. Now I'm just going to go real quickly so you have this, because you have that information just in case. International screening process is basically the company going to be looking at. It's Lincoln Company, identify prospective targets. They're going to look at open up a subsidiary in Mexico or Brazil or Colombia or Canada. Big extremes. And here's the exhibit, local economic condition, favorable, okay. Local political, okay, valid. Colombia, so that there's a risk in there. Local currency, okay, favorable. Canada, slightly unfavorable for whatever reason. You gotta look at it. Just a couple of years back, when you're looking at your MMC and the subsidiary, you're gonna open up for your final project for this course. You're gonna tell me this country. You're gonna look at what is the condition. You're gonna say I looked at 2 or 3 different countries, for lack of better words, and this is the one. You got to have some evaluation. Why did I pick? Or you can say, hey, we're right next to Mexico, I'm Texas, I'm California. This makes sense if we're going to go across the border, and that. So you're not really looking at, but you may look at that one, or why not keep it domestically? May change, may not change. Reasonable. Okay. Now target expected cash flows, measured by determining the revenue and expense levels in recent years, adjusting those levels to reflect the changes after the acquisition. So I'm looking a couple of years back and going forward. Unless there's a real drastic, something else with the political climate going back and forth, a little different issue. If I look at Greece is starting back up at the beginning. Is it? I'll do it, but how much? Are they going to go? Going to do a tailspin again? I'm just using that as an example since it's current. Okay, estimated target value. Okay, now I'm looking at this. Here's the estimated target value. So here's the revenue year 1, year 2, and you've got the target value of a Canadian target base on the assumption provided millions of dollars. It's just one. What's the selling administrator? What's the depreciation? What's my tax rate? 30%. So I'm looking at these numbers. I'm looking at the last couple of years, last year, this year, and here's what their projection costs are. Okay. And the cash flow, and then discount rise, cumulative present value. Okay, so now you have got the starts to look at it. This is just one. You do it for Mexico, you do it for Brazil, or the two or one other country that I expect you to be doing it for your own project that you're doing as a team. Okay, estimated revenue targets. Forecast revenue is in Canadian dollars of 1 million over next year. Following year is 93, and then 121 million in the following year after that. Okay, estimated, and you get the numbers from here. Cost of goods sold expected to fall 40% of revenue because of improvement in efficiency. So I'm going to have some savings. Cost of goods sold, right? The numbers are going down because of the efficiencies. And like I said, look at this. I'm going quickly. Stop. Open them up. Earning before taxes, earning after taxes are estimated. Cash flow to the parent. Lincoln's parent wishes to assess the target from its own perspective. It focuses on the dollar cash flow that it expects to receive. Okay, valuing the present value of estimated cash flows, assuming a required rate of return of 20%. The present value of the target estimate is 158 million after 3 years. Now, sources of uncertainty: the growth rate of the revenue is subject to uncertainty. I'm assuming it's going to be consistent if all these other factors are constant. Cost of goods sold could exceed assumed level. There's always that assumption. Selling and administrative expenses could exceed assumptions. These are my best guess. Corporate tax rates could increase. There's always something depending on what's happening in the environment. Maybe not necessarily. I'm looking at some kind of increase, but is it a consistent increase? It's easy for me to map, or is it going to be from one extreme to the other? I have to look at that. Exchange rate may be weaker than expected. Estimated selling price at target in the future may be incorrect. So here's my selling price of the goods I'm selling. I could mess it off, but I'm making a lot of assumptions. There's always a risk factor in there. Okay, changes in valuation over time. So this is, remember, we're looking at this one here. We're looking at, this is an example of valuation process. Okay, impact of the stock market conditions. After prices of the share each stock in that market, a change of stock market condition could change, because I'm either buying or selling. Impact of credit availability impacts the ability of MMC to make acquisitions, whether it's from the parent, the economic conditions, or it is a subsidiary. Where am I going to get that financing from? Impact of exchange rate, that is a big difference because I'm looking at bringing value. What's going on with the currency? If the foreign currency appreciates, its goods is worth more. By the time the acquirer makes the payments, the acquisition will be costly. So I'm looking at where it's at. If it's too many improvements, it's going to cost me more to buy it or sell it. Okay. Impact of anticipation regarding to the target. Stock prices on the target may increase, almost given, depending, unless it's really low junk stock, it's going to increase. So people are looking, hey, there's this new buyer coming in there. I want to be part of this action. I think they're going to be able to turn around, depending on the parent MMC. And the investor anticipates that the target will be acquired because they are worth the stock prices of the target rise abruptly after a bid of acquiring firm. They're going to go up because people say, hey, you want it, you're going to have to pay a little bit more. They try to keep it low key, or they acquire the stocks prior before people know what's going on. Kind of hard to do it nowadays because if there's any kind of movement, stocks, technology, and software will pick it up. Okay, disparity in foreign target valuations. We're doing good on time. Okay, so I broke this down A, B, and C. Expected cash flow in foreign targets, A. Each MMC may have a different plan. Remember, this is just generic. That's what when you're looking to look at, when you're taking this course, or you're doing it from your own perspective, how I'm going to do it for my business, my MC that I'm working, or in a company I'm looking at it, depending on what are you trying to strive? You have to know your mission. Is it increase in share? Is it to turn the company around? Is it increase profitability? Are we declining? What am I doing? Do I have to shed off some weight and restructure myself? All that depending on your organization, on the structure, what fits, how you will conduct your future operations. Okay? Exchange rates effects on remitted earnings. That's money coming back. Valuation could vary among MMCs. Okay, either the parent or the subsidiary, because of different exchange rate effects. Acquire the rate, required return of acquirer. The valuation of the target could also vary among the MMCs because of differences in their required rate of return. So there's some disparity. It's a little harder when you go international because of the different things, but you have a good handle. You're trying to compare apples with apples. All right, corporate control decisions. Other corporate control decisions that we'll have in here. Let me just turn these off in here. Okay, we'll start off. It'll be easier. Okay, so what do we have? International partial acquisitions, international privatization of business, international divestitures, and valuation of processes. Those are other corporate controls that we have. So let's look at this one. The first one we're going to have, international partial acquisition. A partial acquisition, that's what it is, requires less funds. Only a portion of the fund's target shares are purchased. I'm not buying out. I'm doing a partner with somebody else. So hopefully we're working together. So we're a partnership, for lack of better words. No need to go on into that to confuse you. Valuation process. When MC considers a partial acquisition, it must take the perspective of a passive investor. Partial, I don't have all to say. It's look, when I was single, I could do anything I want. When I'm married, I had to talk to my wife. When I got kids, I talk to the wife and the family to make sure the time frames are adjustable, that everyone could make this meeting or make this trip. So things change, okay? So now I'm just as a passive investor rather than a decision maker, okay? International acquisitions of privatized businesses, and you can see some of that, which would be a good case studies. What's going to be happening in Cuba once that the embargo on the relationship gets more. You see a lot of investors coming in there. Cuba's real close. Got a lot of ocean. Got a lot of resources that used to be here. Could be another vacation, could be another tourist. A lot of things could happen. So when I'm looking at that, the Cuban government is already opened up privatization to its local residents or constituents. Will it open up again to the U.S. market? Remember, that was the problem why the Castro and the government, because it became so capitalized that the locals were being no longer getting any advantages of their sovereign wealth from the organization, from the Cuban government, because everything else was sold off and owned. So they took it over. So they don't want to go back that way. That's the history. So now I know there's going to be a little more policies, a little more control. But how much are going to privatize back again? And to what are the rules? Okay, future cash flows uncertain due to the intro of competition. Okay, international privatization. Data regarding value and benchmark is limited. The governments always were doing well. Political conditions are vital. It could be unstable. Right now, maybe, may not. Let's see what happens. Political, potential conflict between government control and inquiries may exist. So the government, and you're looking what happened in Russia, you have the real rich that took it over because people didn't know what to do with the stocks. When they privatized, didn't have a stock exchange, so people were buying their shares, and then you have your very wealthy that just took advantage of that. Okay, international divestitures are basically commonly external forces that could reduce the present value of a foreign subsidiary's future cash flow. Present value, that's all you have to highlight, and foreign cash flow. Weakening the economy in the host country could reduce the expected cash flows to be generated by the subsidiary. All right, the host country, this is what's happening with China now when they're devaluated. They're driving the investors crazy on both sides. Okay, reduction in local currency of the host country could reduce the exchange rate by which the cash flows generated by the subsidiary could be converted into dollars. Higher taxes, again, imposed by the host government could reduce the expected cash flows of the subsidiary. I'm trying to get money back into it. Nice to have all that. How do I pull it back? I get all my investments. How do I bring it back to the parent where I want it? Okay, increase. So my books look good here, my investments, everything else. So when I'm looking at my profits and everything else is looking good from the parent company, that's where the shareholders are investing into it. Increase in the MMC's parent cost of capital would increase the discount rate at which expected future cash flows are discounted when determining the present value of the subsidiary. Okay? And here's the valuation process required comparing the present value of the cash flows. If the project continued to proceed, the money I'm getting would be received after taxes if the project is divested. Okay, and here's an example. After taxes, you can look at it. And this is part notes from the other one. I thought they would keep with this one, and we didn't have it, so they're bringing it back in. All right? Okay, so we have that. Now the last one we have in here, let me just close this off. Okay, is control decisions as real options. Okay, so let's go in here. First of all, let's give me what real options are. Are implicit options on real assets as building, machinery, and other assets. Those are real options. Call options on real assets represents a proposed project that contains an option of purchasing additional ventures. Okay, call option. I have a put option on the real asset represent proposed project that contain an option of divesting part of all of the projects. Okay, so those are my two. One, really it's these two: call option on real asset and call options on a call input. Okay, so that takes care of that. And we're at the summary. Hey, we're almost done here. Under an hour. Okay, so let's see. Let's leave this in summary. We have 7 topics that we talked about out of this chapter, or 8 for lack of better words. What do we talk about? Summarization, we talked about the board of directors. We'll get into their institutional investors. We talk who those are. We talk about block holders. We talk about international market. We talk about how the valuation of the target market, typical valuation process, real quickly overview, valuation, how you evaluate foreign targets, international corporate control, and transactions included. So if I'm looking at the board of directors, real quickly, an overview. MMC Board of Directors responsible for ensuring that its management focuses on maximizing the wealth of its shareholders. Always value of the parent. The board should be more effective if they don't have any members on the board. Okay, not the chief, the vice president, because you still have some bias, for lack of a better word. They found out the boards that have not the CEO or anyone else or any kind of management on the board of directors, but all outsiders, even though there's some politics in there, are a lot more, I want to say transparent, but and a lot more honest and forthcoming going forward. Just still some bias in there, but not to that extent. Okay, institutional investors. Remember, we talked about the management. If I have management on there, I want to try to favor the management because that's part of the group I come out of there. Okay, institutional investors monitor the MMC. You know, the large ones monitor. They're in the process. They've got the historical data. They want to make sure that they're, if they're mutual funds or electronic transfer funds. They're basically for their shareholders that they're getting the best return on their investment. Okay, but they have that. Some institutional investors, as hedge funds, tend to be more effective monitors than others because they're watching it. Because they have to show that profitability on the hedge funds or the mutual funds, for lack of better words. Okay, block holders who have a large stake in the firm may also serve as effective monitors, can influence management because of their voting power. Now, you're going to have also some block holders that could be the hedge funds, it could be special, unless they're really going out of the way, doing something really unethical, they're going to get involved. Mostly if they're giving me a good return and they're stable, they kind of leave it kind of, they already had the relationships with the board members. Okay, some of them may be already board members on there. But we're looking at activists that want to change things. They want to be environmental, or they want to do something to change the corporation. The corporation says no, so what do we do? They basically buy a lot of shares at a higher cost, and now they have the control. Okay, now the international market. This is a corporate control serves as another form of governance because public firms do not serve their shareholders, may become subject to takeovers. Okay. That's why managers of public firms can implement some tactics such as anti-takeover provisions and poison pills to protect against takeovers. They make some kind of a buyout or some kind of protections. And remember, when I'm buying a company, I got to take it by the rules and condition. No different than I'm doing factoring, I'm throwing a little finance. If I'm buying different loans, I have to abide by the rules and contractual agreements in terms of condition as I purchase that. So they'll put something in there that doesn't make it feasible, because if they buy them out, it's going to be, it keeps on reduced. It costs me so much, and how much is my product? If I'm looking, let's go real quickly, just for a general, so people know. If you look at a lot of gas stations, a lot of gas stations out now are all corporate, owned by corporations. Very small independents. You see very few of them. And what's the rationale? Because a lot of the old gas stations, they had the tanks and the leak the gasoline and everything else in there. And because of EPA requirements, there's no way a small business owner could afford to clean out, take all that toxic waste, dispose of it. Too costly, too long. A corporation buys out, they've got the technology, they've got the cost to clean up the land, they'll do it, and now and becomes back into corporate. The corporate, so there's a small mom and pop gas station, very few. They're more on the larger one. And where's the money? Not in the gas, not in the repair of the cars, because it's more complicated. The money's into the junk food or the quick market. Okay, but they'll know that. Okay, now valuation of a firm's target. So influence of the target specific factors, the target's previous cash flows, and managerial talent. Sometimes I'm not looking at they're breaking even or they're struggling, but it could be environmental forces. I could just need some cash to revitalize themselves. A little different. That's what Chapter 11 does. Is that, I just need to restructure my debt. I could do it because things hit me all at once. I wasn't prepared for it. No different than bankruptcy for individuals. They don't take everything away. They get you going, and hopefully you come back to life. Look at Donald Trump. He lost all his money, came right back up there, and he's even wealthier than he was before. Okay, so you've got influence by target, by factors by conditions, economic conditions, political, currency. It's just a reminder. Now, look, as we're going forward in these chapters, you see there's a common theme going in there: hedging, buying, bidding. Okay, risk, control. There's the math. What's the present value? What's the value of the organization? How do I value the organization? Is it overvalued? Is it undervalued? How do I make it more valuable to stockholders? Or how do I undervalue so it's not a good deal? So a lot of this stuff or information you're learning, it's all carrying over. Remember, we're doing little chunks, and now we're talking more globally for the organization. We broke it down, how it affects it, how the governments are doing it in the regions, and now we're looking at multinational organizations, how I'm looking at it a little differently, but I have to understand all the different factors that affect it. Okay, now typical valuation process, what it is, MSC initially screens prospective targets, what I want to purchase, based on a willingness to be acquired. I'd rather have it be friendly, don't want to have it hostile, and because it's likely to be damaged by the time I buy something or finally get possession of it. Countries, different barriers. Each prospect target is valued by estimating cash flows based on the target-specific characteristics and the country's characteristics, and discounting those expected cash flows. Remember, in the future, I got discounted to here, so I'm comparing apples to apples. Similar techniques that you've done in finance. Okay, previous value is compared to the target's market value, is to determine whether the target market can be purchased at a price that is below the perceived value. From the MMC perspective, I'm always looking for the deal. I don't want to pay full price. Look, sometimes I pay full price because I may not. If I'm looking at the little, real quickly, if I look at the AT&T, when they purchased when SBC purchased AT&T, they were purchasing just some capital, some infrastructure. They're basically purchasing. They paid a lot of money for it. They were purchasing it more for the name recognition, because global. AT&T had a global name recognition off on the bat. Even though the SBC had a poor name recognition, had a lot of poor things going on. It's almost like I just got married and I got a new life. So SBC, when they purchase AT&T, usually the company that purchases the other individual will take on that company's name. This was strictly done in reverse for those for various reasons. Those were one of the main reasons. Okay, valuations of foreign targets, may vary among potential acquirers. Differences, let me move this over so you can read it. Differences may be exceptionally pronounced because of difference in estimates and target cash flows or exchange rate movements. And here's a note. or the differences in the required rate of return among the acquirers, the current companies, when the potential acquirers are from different countries. Like it or not, sometimes it's hard because it depends on their accounting system, depending on the government and rules. But I'm in that company and I'm purchasing it. I have to do my forensic accounting to decipher what's actually going out there. What are they doing? Have they been cooking the books, for lack of better words? We got the SOX things looking at that now going forward, but I'm stuck with an organization here. So that's what I'm looking at. Okay, international corporate control transactions include international acquisitions of firms, include international partial acquisition, depends what makes sense for the strategy, what's to bring up the value. Sometimes I just need the value for a couple of quarters, then I get rid of it because something else is going on. Because I'm looking at my strategic plan. There's more than 2 years, hopefully 5 years, and maybe down the road I'm looking at it. And a lot of companies, I'm looking at a lot of the rules, and now the companies have to identify here in the U.S. what's the price differential between my managers and my bottom employees. That's, if you look at the U.S. has the highest paid executives and the worst turnaround, for lack of better words, of performing companies, where the multinational organizations are productive and the executives don't get as paid as much, but they're not the risk takers, but more of a longer term to maintain the sustainability of the MNC going forward and adjust to different factors, either political or environmental or the market. Okay? So, international acquisition of privatized businesses. Cuba would be a nice one going forward. Maybe next time I'm teaching that, we'll be focusing on Cuba. As let's open up a subsidiary there. Would be a good example because you could get a lot of information. They'll be giving out more, and some of it isn't. It's the risk, and we'll see how you. It'd be a great learning. I'm just saying, it'd be a good case study. Feasibility of these types of, and it's something you could also say I'm going to open up, even though you may not have all that for another 10 years, but you go and look, another 3 years, we'll be ready to open up in here because we see the dynamics is changing. But then you're looking at what's going to happen with the election next year. If the election comes in next year, will the Republican change it or slow down that momentum? Maybe not, it's business, and that's the thing when you're looking international, political. People are looking here before they invest. Is it going to be Hillary Clinton, or is it going to be Donald Trump? There's be a completely different relationship. Good or bad? I'm just saying one way, okay? All right. So now when we look at that, we're finished. Let me just close everything down, and I'll do a nice summary here. Okay, so we've covered everything else in here, and like I said, remember, you're going to do some math problems. The homework problems are just math for you to do the math problem. My whole contention of this whole course, Introduction to International Finance, offered at a community college, Harper Community College, or any community college you're taking, is to give you the basic fundamentals of the conceptuals, the strategies, the vocabulary, everything else, some math. Your exams, I'm not going to be asking you exams. I'm going to ask you different strategical approaches. What do you do here? How would I buy this? What do you think is, what factors should I look for? What are the economic factors? What do you think is going to happen to if the exchange rate goes down or if it goes up? Is the currency going to be valued or devalued? Those are the questions you're going to be asking. Those are the terminology. The math you could figure out. A lot of times even with the math, if I'm looking at the problem or I'm doing the problem because I got to refresh my mind how to do them because I do everything else through spreadsheets or through software. You just understand what the item. I'm looking at the bottom line on there. Okay? So again, take this course. It's Finance 225 offered at Harper College. Ask for me, Dr. George Mochocki. I'm trying to pay off my student loan. Keep on throwing that in there. Or take me for other classes. I'm a contractor at a college or adjunct lecturer for Harper in College Lake County. So you can look me up in there if you like this. And then, take the course. You get the credit hours, so it's transferable. You get something more than just as a workshop. You can say, hey, I got a credit hour, and it's good to have international marketing. I'll sometimes teach international management, international finance. I'm teaching now, so international business. Have something on there international, because like it or not, all companies, small to large, have some international components, especially with the internet. We've got the e-commerce, so I could have people buying from other countries, or I could decide to open up there and open up because my product's too saturated here, instead of going to the United States, I'm close to Canada, go to Canada, close to Mexico, or the European Union, or UK, they speak English. I don't have to do much of a change. They have something similar, or even to China. China will encourage a lot of small businesses. They trust small businesses over the corporation, which they think is government run or more capitalistic. Because if you look at China, their whole model is a lot of small individuals working to do the cause, more of a privatization, so you may have a better aspect making those connections, and as your company grows financially, makes sense. Or hopefully, remember, what did we, those of you who have taken me for other classes in marketing and everything else, the whole thing is, hey, I'm an entrepreneur, I'm a business owner, somebody will buy me out, I start a new process, another thing that I want to do, and make money of this and plant the seeds, or sell off part of, MMC a lot of times will sell off certain parts of their operations or their subsidiaries because it doesn't make sense for the new strategic value, or there's a competitor that does it, or there's another distribution that does, they get outsourced, and I could still have the same kind of a better return on my investment and sell this off and utilize that money for another project I want to do. That's the fun of finance. Anything you're going to do in finance, anything you're going to do, has to have a dollar attached to it, and that's what you're learning here, the dollar. But you have to conceptually think, what am I doing? And then I'll figure out how much it's going to cost me. That's what finance is doing. All right. So again, thank you for taking this course, and remember, take it at community college or look us up. And just a general idea. If it's confusing, you need the book. You need to go to class. You need to go either take an online class and do the lecturing. And I'll see you next time. And I think I am going to need an hour. Cross my fingers.